Today, my name is Dela Imibo, and I'm your export doctor. Thank you for stopping by on Global Trade Tutor YouTube channel today. In today's video, I'll continue the conversation I've been talking about what no one tells you about export contracts. And in today, I'll be looking at insurance. What no one tells you about insurance in export contract. What no one tells you about insurance in export contract. Now, can we talk? You know, there's a challenge with many people that go into export because many people don't have culture of insurance. So you know what happened? Some people don't do insurance. Some people don't do insurance. And it's very unfortunate that they do not do insurance. There are two incoterms that put the responsibility for insurance at the disposal of the exporter. That transfer the responsibility for insurance to the exporter. And this includes number one, CIP, cost, carriage insurance paid to, and CIF, cost, insurance, and freight. If you are not familiar with Incoterm, you can go and watch my YouTube video on Incoterm. You get to learn more about international commercial terms, which separate transaction cost and risk between buyers and sellers, international trade transaction. Insurance section of the export contract outlines the responsibilities and requirements and arrangements related to ensuring that the goods are insured during transit from the exporter's port of loading to the importer's port of destination. From the exporter port of loading to the importer's port of destination. This section is essential for clarifying the parties' obligation regarding insurance coverage, risk allocation, and claim handling. Let's take them one by one. Insurance coverage. The contract should specify the type of insurance required for the exported goods, including the coverage of loss or damage due to perils such as theft, fire, natural disaster, accident, and transportation-related risk. Now, if you are familiar with insurance, for marine insurance, we have clause A, we have clause B, we have clause C. Clause A covers all risk. Let me start with clause C. Clause C covers risk that has to do with issue having to do with the vessel. Vessel run aground, vessel collision, vessel mechanical fault with the vessel. The second, clause B, cover all that clause C cover. In addition, it covers perils, natural disaster on the sea, tsunami, earthquake, wave, tempest, issue that has natural disaster on the sea. Clause A cover all that B and C cover and all risk, but does not cover issue that has to do with your negligence. So you must indicate what does it cover. Damage, loss in transit, peril, such as theft or fire, natural disaster, accident. Clause A, I would just strongly recommend straight up, please do clause A insurance, period. Some contract might indicate the insurance they want. They want an insurance maybe that have capacity. So the contract may designate a specific insurance provider or require the exporter to obtain insurance coverage from a reputable and financially sound insurance company authorized to provide coverage for international shipment. The insurer should be capable of issuing insurance policy that meet the requirement of the contract and provide adequate coverage. Typically, most contracts will indicate 110%. Some might indicate 120%. That means if the value of the good is $100,000, is $50,000, 110% means I will insure $55,000. If the value of the good is $60,000 and it's showing 120%, then I will insure $72,000. That's $60,000 plus 20%, which is $6,000 and $6,000, which is $12,000 plus $60,000, that's $70,000. Some people want you to insure a lot more. I mean, the issue here is that we're trying to cover risk, right? So it can be a lot more than, usually more, because the idea is that when the insurance company pay, they don't pay in full. So if you insure 120% and they pay 100%, that will cover your capital. And sometimes also it is profit. Sometimes when you insure the value of the goods, but sometimes you might not be insuring total value of invoice with your profit. So sometimes it also cover profit of the exporter. So the contract should specify also the insured value, which typically corresponds to invoice value or the cost of the goods. The contract may also specify the amount deductible or self-insured retention applicable to the insurance coverage, which represent the portion of the loss that insured parties are responsible to cover. So in marine insurance, there is what is called excess and franchise. Excess and franchise. So if my insurance is subject to excess or franchise, that means buyer and seller have agreed that if there is a threshold that if the loss is below this threshold, will bear the cost. So for example, if the good is $60,000 and my loss is $6,000, 10%, and my threshold is 20%, $12,000, that means that kind of risk, I won't be able to claim from insurance. I'll bear that cost myself. Because my threshold is 20%, which is $12,000. If for any reason the loss is now $15,000, remember my threshold is $10,000. If I do franchise, I'll be paid in full. That means that $50,000 loss will be paid back to me. If I do excess or deductible, that's if my insurance coverage is excess or deductible, and you will see that clause on your insurance certificate. That means they will not pay me full like franchise. They will pay me the difference between my loss and the threshold. They are paying me excess over and above the loss. Excess over and above the loss. But if it's franchise, I'll be paid the full as long as the total loss is equal to or more than the threshold. So look out for that contract, that excess or deductible, and confirm what do you want, you and your buyer. What do you want? Excess or deductible. Then insurance documentation. Insurance documentation. The contract should require the exporter to provide the buyer with the evidence of insurance coverage. And that would be an insurance certificate or an insurance policy. There will be an insurance certificate or an insurance policy or an insurance policy. Now, let me differentiate. Insurance certificate is a certificate. It doesn't have a policy attached. Insurance is separated. Insurance policy is separated. Insurance policy contains the certificate and the term and conditions. So when you are asking for insurance certificate, that means term and condition will not be attached. But you can get it, but it will not be attached. But if you ask for insurance policy, term and condition will be attached to it, and both of them will be required together. Both of them will be required together to be presented. Now, that means this insurance document will be among the documents that will be presented. The contract should also specify the term and condition of the insurance coverage. The contract should clarify which party is responsible for paying for the insurance. Incoterm will have defined that. And if a CIF, the risk in transit is the risk of the importer, not the exporter, even though the exporter is the one that pays for insurance. So the exporter can now indicate on the insurance that the first loss payee will be the buyer, because the risk in transit, if the Incoterm is CFR or CIF or CPT or CIP, in CIF and CIP, exporter is one paying for insurance, but the importer is the one incurring the insurance. These two Incoterms say exporter must pay the insurance. What that means is that the exporter, if anything goes wrong in transit, the exporter will still get his payment because it's not the one carrying the risk based on the contract, but the buyer will be the one to claim. So the first loss payee will be the buyer of the goods. Has this video been of help to you? Give it a thumbs up. Do you have a friend that is about to sign the contract that need to hear this? Share with your friends. Are you new to this platform? Subscribe and click on the notification bell so you know when I upload a new video. If you have a question for me, drop it in the comment section. I'll be waiting for you in the comment section. My name is Delayemi Bo, and I'm your expert doctor, and we're signing off.